All right, video 3 in the beginner's guide to properly structured whole life insurance. In the last video, we talked about on the whiteboard the difference between max funding and minimally funding and why someone would want to overpay. Now we're actually going to look at the numbers, and we're taking a company that's a great company, but we're just looking at not every contract is funded properly. And so you're going to look at a typical traditional policy versus a max funded policy. And one of my colleagues will walk you through that and look at the flexibility, look at the cash value available, look at the permanent death benefit, and you'll start seeing that you can have the great company, you can have the right mindset, but if your contract's not funded properly, it just might be night and day from what you can get. And this is a lot of the criticism that we get when it comes to whole life insurance or just life insurance in general comes from the poorly designed policies that are out there. And unfortunately, if you don't know that this exists, a lot of people do get a poorly designed policy in the process of getting life insurance. So without further ado, enjoy this video.
All right, in this video, we're going to discuss how to properly structure what we call an and asset, essentially overfunded whole life insurance. We're going to go into the differences between what typical whole life insurance looks like and what individuals like Dave Ramsey, Susie Orman, individuals that have a lot of clout in the financial space, why they talk about whole life insurance being a terrible place to store capital and using it as an investment, which life insurance is not an investment whatsoever. But what we're going to do is we're going to show you the differences between the and asset and the typical financial planning, typical agent, whole life insurance, and why we believe that if structured properly, which I'm going to show you how to properly structure it, is an amazing place to store capital. And there's 1,000 benefits that are involved with life insurance, and we are going to just take a peek at what makes up the components of it, why is it overfunded, and what a properly overfunded structure looks like. So we'll go ahead and dive into that. So I'm going to share with you here 2 different designs. Okay, the first design is going to be the typical whole life insurance that most people are aware of, that people like Dave Ramsey will talk about it being a terrible place to store money and it being an investment. When we're looking at this, we are going to have a $100,000 premium. Okay, just know that these can be numbers that can fit your contribution, your essentially financial situation. $100,000 is an easy number for math that we can use to let you know what's possible. You can look at this as 50,000 a year, 10,000 a year, 5,000 a year. The numbers are going to be different slightly from a cash value standpoint, death benefit standpoint, based off of the numbers, which is perfectly fine. The whole point of this video is to just show you what a properly structured policy looks like and what overfunding really does look like, and the differences between a non-structured one that's not properly structured and a one that is properly structured. So this one is going to be the non-properly structured one, typical whole life insurance. We have $100,000 a year going into the policy, and this here is going to be our total cash value column. So this is the column that we have from a standpoint of the money that we have available to use, essentially borrow against. And here's going to be our column, cumulative premium of the dollars that we've put in total. So in this example, we've put in $100,000 year one. You'll see that you have $0 essentially in cash value to be able to use to borrow, liquidity, all of the fun stuff in this typical traditional, right? Year two, we put in a total of 200,000 and we have $0 again in year two. The reason this is because majority of it is going to the cost of insurance, which is essentially the death benefit. So typical whole life, the whole plan is let's put in a specific dollar amount and let's try to get as much death benefit as possible. So essentially you put in 100,000, we get about $8 million of death benefit for $100,000 a year. So this $100,000 is paying for this $8 million of death benefit. As we continue to go on, what you'll see is that our cash value does start to grow at year three. And now some of the dollars that we're putting in are now starting to get converted to cash value. You'll see the dollar amount that we put in here is $1 million at year 10. and we still only have 929 of cash value. So we still have put in more money than the amount of money that we have available to use. This changes at year 12. So year 12, I put in $1.2 million. I now have 1.249. So finally, at year 12, what we call the break-even point, I have more cash value to be able to use than the actual dollars that I put into it in regards to this traditional whole life policy. You'll see that the death benefit will also continue to increase and it'll go up over time. From a flexibility standpoint, there is no flexibility in regards to this. And when I say flexibility, I mean the amount of contribution that you are required to pay. So this $100,000 total premium, you are required to pay that $100,000 every single year, year in and year out. That is the total amount that you have to find a way to contribute. There is no flexibility. If you do not pay that $100,000, what will end up happening is one of two things: is it'll come from your cash value if there's cash value available. And if you don't, the policy will lapse and you'll no longer have that. And if you do that, let's just say year 3, you've put in $300,000 into it. You don't have enough cash value to pay for the following year. Your policy lapses. You essentially lost every single dollar that you put into it. Except with cash value that's available, which would be about $50,000. So you would have been out about $250,000 of net based off of this essentially illustration here, if you did not have the funds to pay to make that contribution. So absolutely no flexibility, high death benefit, no cash value, and this is what a typical structure looks like for a typical life. Now what I'm going to do is I'm going to share with you what an and asset looks like and why we love essentially the and asset for a place to store capital. So essentially same exact everything from a contribution standpoint. I've put in $100,000 a year as the total dollar amount, right? Now you're going to see the total cumulative premium, same exact number here, 100, 200, 300, so on and so forth. Now you're going to see the difference in total cash value. Okay, so we showed in the previous example, year 1, there was $0. Year 1 here, there's $80,000. So there's about 80% liquidity after year 1. Year 2, there's 168. Year 3, there's 269. So if we go back to here, year 3 on this example, year 3, there's $50,000. Year 3 here, there's 269. Drastic difference. You're asking, well, how is that possible? Why is that? You look at the death benefit on this properly structured policy, $2,566,000 year 1, versus the death benefit in this one, $7 million, almost $8 million. So we have a high death benefit, no cash value. We have a lot lower death benefit, $2,500,000, a lot more cash value. So our whole goal to properly structure a policy is to minimize the expenses, minimize the death benefit as much as we possibly can to where it's still considered insurance. And by doing so, more dollars will go towards our cash value. And we do that by putting on a few riders, paid up addition riders, term riders, essentially riders that allow this to be cash rich versus death benefit rich. And so you'll see that in this design, our break-even point when we have more cash value than we put into it is at year 5. We have put in $500,000. Our break-even, we have $501. So we have a lot more liquidity, a lot more cash value. We have a lot lower death benefit. You'll see that, we get to 8 million death benefit right around year 19 versus year 1 that we had in the other policy. So there's a massive difference in regards to the amount of death benefit. And consequently, there's a huge advantage in the amount of cash value that we have. The other advantage that this properly structured policy has is there is flexibility in regards to how we can pay our premium. So in the previous example, we were required to pay that $100,000 every single year. In the properly structured one, there is a difference because we have put those riders on there, and now we have a floor that is a lot smaller than that $100,000. So you're going to see that this policy here, it's about $14,398 here, which is essentially your base insurance, which is essentially going towards the death benefit. That is right around our minimum floor. I would say put in a little bit extra, probably around $1,000 or so, because we have a term rider that we have to pay for as well. So I'm just going to round it in an example for this example purpose, and I'm going to say $15,000 is our floor. So you get into a pickle, you don't have a cash flow, loss of job, weren't able to save as much for the year, you don't have to make the full $100,000 contribution. You can only pay that $15,000 to keep the policy in force so the policy doesn't lapse, so the policy can keep growing, keep doing its thing, and still operating like an and asset. So those are the major differences. Is just to summarize again, from a properly structured policy to a non-properly structured, our whole goal from a properly structured is to minimize the death benefit as low as we possibly can, to get as much cash as we possibly can into the cash value, to then have liquidity to be able to use as needed. And by doing so, we also have the ability to have flexibility in regards to the amount that we are contributing. So I hope this helps in clarifying the differences between a properly structured, overfunded whole life insurance policy, which we called an and asset, and a traditional whole life insurance policy, and taking a look at the two and comparing them side by side. As I truly believe that the and asset is a great place to store capital if it is properly funded, properly structured in the right way, versus the typical whole life insurance policy, in my opinion, is not a great place to store capital. And I agree with people like Dave Ramsey. Thank you so much for watching, and we'll talk to you soon.
Hey, it's Caleb Williams here. I want to thank you so much for taking time out of your busy day to watch our YouTube videos. We put a lot of time and energy into making them informational and helpful. I also want you to know that we do this for a living. So if you're an advisor, an agent, and want to learn more about the and asset and how to incorporate this into your life, check us out at theandasset.com. Also, if you're a consumer, if you're someone that wants to learn more about the and asset in your business or in your retirement plan or in your life, and asking questions like, would this be beneficial to me? We want to help you. You can check us out at andasset.com. We have links down in the description where you can get the book, you can watch different videos and learn more. We just appreciate you. We appreciate if you give this video a like, give us a comment, and share this with people that need to see this content.